Hey everyone, welcome to chapter four's example. And in this example, we are going to be dealing with the entire accounting cycle, but doing it from a retail store's perspective, looking at inventory and how all those special things dealing with inventory work in journal entries and T tables, as well as doing the adjustments and doing the financial statements and doing the closings as well. So this is, I believe, a three-part video series on this example. I would highly suggest you to take a minute, pause, and see if you can do this on your own. This is a great way to see kind of where you're at. I'm a firm believer of you need to know what you don't know and what you do know. And the best way to do that is to actually do this on your own to figure out what you do and don't know, and then come back and watch the video to see what you got right, what you got wrong, and why you got it wrong. So if you haven't done it yet, please pause it and do it. I know it's lengthy. I know it gets there, but I promise you it'll help you out in the long run. So for those who are watching this for the answer portion of it, let's get to it. It says Charlie Company opened their doors on January 1st of 2000, whatever, with the intentions of selling widgets to customers in their area. The following events occurred during the first year of operations. Complete the accounting cycle for year one for Charlie Company. So January 1st, Charlie acquired $35,000 cash in exchange for common stock. This one should be a no-brainer. We've done this one quite a bit. But we are going to debit cash because we are getting cash. Remember, I like to start with cash. So it's going to be 1-1 cash of 35,000, and we are going to credit common stock. Again, straightforward. We've been doing this one from the very beginning. So also we need to put that into our T tables. There's our T tables, cash and common stock T tables. 1-2 or January 2nd. Charlie Company purchased widgets, which again are our inventory, from a supplier for $10,000. Now it doesn't say cash, but we can assume cash because it doesn't say anything else about on account. So again, 1-2. But what is my cash doing, or is cash affected here? Yes, it is affected. What is my cash doing? Well, it's going down because we bought these with cash. So I'm going to credit cash for $10,000. And then what is my debiting account? Well, I'm getting inventory. So I'm going to debit my inventory by $10,000 as well. And then I'm going to put those into the T tables. I already got cash and create an inventory T table. Cash, again, typically is going to be your longer T table. Inventory is going to be right up there with it. It's pretty lengthy too. So just give yourself some room. All right, let's look at January 3rd. The purchase made on January 2nd had shipping terms of FOB shipping point, and the responsible party paid $250 cash. So in this one, we need to know, one, who's the responsible party. And so FOB shipping point, if you remember when we talked about this, that is the buyer's responsibility. Because remember, the buyer assumes responsibility or assumes liability from the point of shipment all the way through transportation to the destination. So this is the buyer's responsibility. We are the buyer because remember, we are the ones that bought the inventory to be shipped to us. So therefore, if it's the buyer's responsibility and we are the buyer, then we're the ones paying it. So what is our cash? Or is cash affected? Yes, our cash is being affected. It's going down. So I'm going to say 1-3 credit cash for $250. And because we're the buyer and we're getting the inventory, we haven't sold the inventory yet, but we're bringing it to our facility in order to sell it. We're going to include this into the inventory cost. So I'm going to debit inventory again for $250. Had this said the purchase made on January 2nd, then the shipping terms were FOB destination and the responsible party paid $250. We are the buyer. Destination is the seller's responsibility. We would not have paid, so you would have not seen a journal entry for that had it said FOB destination. But because it says FOB shipping point, it is our responsibility. Also, I need to put that into our T tables as well. So there you go. All right, let's look at February 10th. Charlie Company sold widgets that cost $5,000 to a customer at a price of $10,000. So a couple things going on here. We sold these at our sticker price is $10,000. These things that we sold, these widgets that we sold, cost us $5,000. So we need to do our journal entry for this. Remember, it's selling inventory, so it's a two-part journal entry. So first things first, is cash affected? Yes, our cash is affected. So I'm going to start with that. Our cash is going up because our customers paid for it. So cash, and we're going to put the hopefully higher amount. You definitely don't want the lower amount to go in cash because that's a bad business plan. So cash of $10,000. The counterpart to cash is, well, we earn this $10,000. So what do we do with the things we earn? Well, we report them as revenue. And so we're going to call it credit sales revenue for the same $10,000. Now that's half of it. Now I need to do the other half because we also used the inventory and lost the inventory. We sold it and therefore don't have it anymore. So we're going to expense our inventory through cost of goods sold. So we're going to debit that account, cost of goods sold, for the lower amount, which is $5,000. And then also credit inventory because we're lowering our inventory count by $5,000. And then need to create some T-tables, add 2 T-tables. So we're going to get rid of or start with sales revenue and COGS, and then also add to the already existing T-tables of cash and inventory. Now I do want to make it a point for you to know that the difference between these two, what we sold it for and what it cost us, the $10,000 to $5,000, that $5,000, granted, I know it's $5,000, but that $5,000 is not recorded in the journal entries or T-tables. That's our gross profit. That's something that it's going to be found in the financial statements. So you'll never take the difference of these two numbers to put into the journal entries. You will find that later on when we get to the financial statements. So, all right, let's go to February 15th. It says Charlie Company paid $5,000 cash for land they had planned to use as a future store. So has cash been affected, or is cash being affected? Yes, it is. What is our cash doing? It is going down because we purchased the land. So we're going to say $215 credit cash because it's going down for $5,000. And then what are we going to debit? Well, we purchased land. So we got that asset. And so we're going to debit it land of $5,000. And I'm going to create a land T-table and also put the $5,000 into cash. All right, so that is $215. Now let's look at $315. Charlie Company purchased $15,000 of widgets on account. The terms of the purchase were $215 net 30. So not only did we purchase it on account, and they're offering us some credit terms that says if you pay quicker, we'll give you a 2% discount. We don't care about the discount right now. All we care about is we got the inventory. We purchased the inventory. So let's do that. First things first is cash affected? Cash is not affected here because it says on account. So what are we expected to do with the cash? Well, eventually we're expected to pay it. So therefore it is an accounts payable. And if you remember, accounts payable is a minus plus. And so it would go on the credit side. So we would say $315 accounts payable of $15,000. All right, that takes care of that. And what is our debit going to be? Well, what do we get? We got inventory. So we're going to debit inventory for that $15,000. Now notice the discounts didn't come in play yet there because remember, we don't know what the discounts are until we actually pay it. Like what date do we pay it? But if you look at the terms, it says $210 net 30. And just to kind of review, the first one is the discount. So they're offering us a 2% discount on whatever we pay off of our accounts payable within 15 days, but we have to pay the entire thing off in 30 days. So that's just what that means. All right, let's look at 318. 318 says, we need to put those in T-tables. Just forgot about that. All right, there we go. Now we got it. All right, 318 says Charlie Company returned $2,000 worth of widgets purchased on 315 because of defects. So we purchased 15,000, but 2,000 of them had some issues, so we returned them. So we need to do a journal entry for that return. And remember, returning of a purchase is simply the opposite of the original. So the original is inventory AP. So for us to do the journal entry for the return, it's going to be the opposite, which is going to be AP of 2,000 and inventory of 2,000. So I just flipped them. Put that in my T-tables. There we go. All right, so we're done with 318. Now let's look at 328. Charlie Company paid the balance due on accounts payable. Now that's 28. We originally did this on 315. So if you count that out, that's less than 15 days. 15 days would have been put it right at 331. So we are within the discounted period, which means we're getting the 2% discount. Okay, so let's go through this. We're going to take it step by step so I can show you kind of how I logically put it together to make sense to me, and that way I hopefully not forget it. All right, so I'm paying this off. And by paying off my balance, I'm getting rid of my AP. So the first thing I'm going to do is I'm going to get rid of my AP. Now, how much am I paying off of my AP? Well, I had 15,000. I took back 2,000. Please don't forget about the return. I took back 2,000. That means my AP balance right now is 13,000. So that's what I'm getting rid of. So I'll say 328 accounts payable, because again, on the debit, it's going to go away 13,000. Okay, that's part of it. Now, how am I getting rid of that AP? Well, I'm paying cash for it. So I'm going to credit cash, but for how much? I'm not going to pay 13,000. I'm going to pay whatever it is minus the discount, which a 2% discount for 13,000 is going to be $260. So if I subtract 260 from 13,000, that's going to give me a cash that I'm paying of 12,740. Now this last piece, which is the 260, where do I put that? Well, I have to take it out of my inventory because I'm lowering the value or the cost of what it cost me to obtain that inventory. So that inventory is not worth 3,000 to me anymore. It's worth 12,740. Well, it's on my books for 13,000. So I need to lower it by the 260. So I will credit inventory by 260. Yes, I understand that we're not losing physical inventory, but we are losing value of the inventory, and that's what we care about in inventory in financial accounting. All right, so I put that in my T-tables. There we go. All right, so that took care of that one. Now let's go to 5.4. Charlie Company sold on account widgets with a list price of $20,000. The widgets had cost Charlie Company $10,000. The shipping terms of the sale was FOB destination. Charlie Company offered a discount to the customer and with the terms 110 net 30. We're real, generous with our 1% discount. But let's go through this. The thing that I care about right now is the fact that I sold some. So I need to do a journal entry for that. And so the first one is cash being affected? No, cash is not being affected here because it's on account. So what are we expected to do with that cash at a later date? Well, we're expected to receive it because somebody owes us the money. So it's an accounts receivable. So I'll say 5.4, accounts receivable. And again, for the higher amount, 20,000, it better be the higher amount for 20,000. All right. The other side, or its counterpart, is, well, we earned that 20,000. We actually did something for it. We rendered the product. So that's going to be our sales revenue for 20,000. And I skipped the line. There's a reason why this is more practical. This is how you would actually see it. So again, we follow the rules. All debits go first, then all credits come later. So, but that's half of it. Now we need to do the expense side of it, which is the cost of goods sold. So our cost of goods sold is 10,000. That's what we used of our inventory. So we will debit cost of goods sold for 10,000. And then its counterpart is, well, we got rid of the inventory. We sold it. So we're going to lower our inventory by that 10,000. And so that is our journal entry for the sale for 5.4. All right. Now let's go to 5.5. It says that the responsible party paid $300 for shipping costs in regards to the sale on 5.4. Well, if we go back up to 5.4, it says that the shipping terms were FOB destination. And FOB destination is the seller's responsibility, and we are the seller in 5.4. So therefore, it is our responsibility. We are the one paying it. So we need to do a journal entry for that. So we would say 5.4. Oh, excuse me, we did not put those into, we need to put those last ones in T-table. There we go, 5.4 is in T-tables. All right, so 5.5, it is our responsibility. So is cash being affected? It is. Is our cash, we're having to pay for it. So our cash is going down by 300. So I'll say 5.5, credit cash for 300. And then the debit, well, I can't put it into inventory because I've already sold the inventory. I have to expense this in its own account. So I'll just call it delivery expense of 300. All right, so that takes care of 5.5. Let me put them in my T-tables. There's my delivery expense account, and then put it into cash, or take it out of cash, if you will. All right, 5.14. Charlie Company, 5.9. I skipped a date. 5.9. Customers from the 5.4 sale returned $2,000 of the widgets. The widgets cost Charlie $1,000. So of the stuff that we sold, the $20,000 worth of inventory, or $20,000 worth of revenue that we sold on 5.4, they brought back 2,000 of it, and that 2,000 cost us 1,000 originally. So again, this is a return. We need to do the normal, which is opposite of the original, with one minor difference. We're not going to take it directly out of sales revenue. We're going to put it into a different account, and then eventually it will affect sales revenue. We're going to call it sales returns. So let's do the journal entry for that. 59. Again, normally we would put sales revenue, but we're going to put sales returns and allowances. Again, this gives us a clearer case of kind of what's going on. We sold it. We brought it back. We had to bring it back. And its counterpart is going to be accounts receivable because we're going to take it off of their account for 2,000. And then inventory, we're going to debit for the 1,000 because we're getting it back. And then COGS, we're going to credit because we're taking it off of our expense. All right, so that takes care of 5.9. That's the return. All right, we need to put it into T tables. All right, there we go. Now we got everything going well. Let's go to 5.14. Charlie Company, I guess it says obtained. It should say obtained $9,900 cash it's all out of whack. Has received $9,900 as a partial settlement, which has an AP, should say AR value of 10,000 for the sale of on 5/4. I just completely butchered that one. I don't know what happened there, but you kind of get the idea. The customer is paying off $10,000 of their AR by giving us $9,900 cash. Because remember, we gave them that 1% discount. Remember, it was 110 net 30, and so we need to journalize that. So is cash being affected? Yes, cash is being affected. It's going up because they're giving it to us. So we're going to start with that of 514. It's going to be cash and 9,900. Now, by giving us that, they are also getting a discount. They got their 1% discount. Their AR was 10,000. So 1% off of 10,000 is going to be 100. So I'm going to call that sales discount. 100. And then finally, my credit is going to be accounts receivable for 10,000. So that takes care of paying off 10,000 of their account. They only paid me 9,900 in cash because they got a $100 discount. So that's accounting for all those pieces. Put that into our T tables. This is what it looks like. We have a sales discount T table there, all the other stuff, AR and cash. All right, let's look at 6.1. It says Charlie Company received the remaining accounts, should be receivable payment, due from the 5/4 sale. So yes, they originally owed us 20,000 in AR. Then they took back 2,000, so they owed us 18,000. Then they paid off 10,000 of it, but they get the discount, so they still owe us 8,000. And because it's after the discount, discounted period, they get no discount whatsoever. So they're gonna have to pay it in full. So is cash being affected? Yes, it's going up. So cash is gonna be debited, and it's gonna go up by 8,000. That completely gets rid of the rest of their AR. And again, we're going to credit AR for that same 8,000. Put that into our T tables. Okay, so now we're gonna go to 7.15. Says Charlie Company paid $3,000 of selling and admin expense. So this one's pretty straightforward. 7.15, we've got selling and admin expenses, our debit of 3,000. And because it doesn't say anything, we're assuming cash, so cash of 3,000. Put that into our T tables. Looks like that. There we go. All right, let's look at 8.31. Charlie Company sold the land it purchased on 2.15 for $7,500. So remember, on 2.15, we purchased land for $5,000. But now, and we thought we were going to hold on to it and use it for a future store, but maybe the values got too good and we decided to go ahead and sell it and make the difference. So we need to journalize that. So the first question is cash involved? Yes, cash is involved. What is our cash doing? Well, it's going up because we sold it. Somebody gave us that cash. So we're going to say cash debit of $7,500. Now, what do we get rid of? Well, we got rid of the land. So we're going to credit the land, but we're only going to credit the land for what we have it in its T table. If you look at the land T table, we only have 5,000 in there, so we can only take 5,000 out. So I'll credit land for 5,000, but we know that we're off because remember, our debits and our credits have to equal, and right now 7,500 and 5,000 does not equal. So we need to come up with something to show the difference. We know it's going to be 2,500 on the credit side. So what are we going to call that? Well, this is not a normal revenue. This is what we call a capital gains. And what we're going to record it as is a gain on the sale of land. So 2,500. Notice it's not sales revenue because we're not selling inventory. This is not our day-to-day business. If we were a real estate company, maybe. But we're not in the business of selling land. So this is something that's non-operating. This is not normal. So we're going to call it gain on the sale of land. All right, that takes care of 831. Let's go to the next one. Only got 3 more left. Charlie Company borrowed $10,000 from the bank. So we probably had to sign a promissory note. So this is going to be something dealing with notes, and because we owe this is money that we owe. This is going to be a notes payable. So we're going to start with 9-1. Oh, sorry, there's the T tables. Forgot about that one. 9-1. We're going to say cash because we are getting cash of 10,000. And on the other end, we're going to call it notes payable for the credit of 10,000. So our cash goes up, our liability goes up. And here is our T tables. All right, the first 1231, or the first adjustment that we have, it's not really adjustment because we're actually paying this. This is not like something that's dealing with receivables or payables. Remember, cash is never in an adjustment, end of the year adjustment. So this just so happens to be an end of the year entry. But it says Charlie Company paid $250 for interest on the notes payable from 9-1. And so we're actually paying it in cash. So is our cash affected? Yes, it is. What is it doing? It is going down. So we will say cash of $250 is the credit. And then what are we going to call it as the debit? It is not going to be notes payable because we're not changing the principal of the note. What we're doing is this is just the interest that we have to pay in order to use the note. And that's why we're going to expenses, because this is what we have to pay in order to use it. So we're going to call it interest expense for $250. Okay, so that takes care of all of our normal journal entries, our year annual operations entries. The last one says Charlie Company completed their end of the year inventory count and found that they had $8,890 of inventory on hand. So this is actually this is the only adjustment that we're going to have. And so normally we would do a unadjusted trial balance, but because there's only one adjusting entry, we're just going to do a post adjusting or an adjusted trial balance. But let's figure this out. So it says that we have right now on our shelves $8,890 worth of inventory. We need to go through and figure out what we have in inventory on our books. So if we add up all the debits and add up all the credits and subtract the two in our T table, it should come out to be 8,990. So we're off by 100. What we have in our books is $100 higher than what we actually have on our shelves, and we need to bring it to what we actually have on our shelves. So what we would do is we would do a journal entry that says, the interest. I completely forgot about the interest T table. Ooh, there we go. So 1231, we're going to expense the inventory that we lost. We're going to call it COGS. Again, inventory loss, because this is not expense because we sold it. This is just because we lost value or we lost it somehow. Either somebody stole it or whatever, but we lost $100. And then our credit is going to be inventory because we're lowering our inventory by that 100. So it would look like that. Put that in my T tables. Looks like this. There we go. Okay. So that takes care of all of our operational journal entries. That takes care of our adjusting journal entry. The next thing we need to do is to find the account balances for all of these accounts. So again, add up the debits, add up the credits, subtract the two, and the numbers should go on the plus side or the normal side of the T table. So just to kind of give you a heads up or a head start, kind of save some time, I'm just going to post these real quick. Our cash ending inventory is $48,860. Our ending inventory for ending balance for inventory is going to be $8,890, which makes sense because remember our adjusting entry said that we still had $8,890 on hand. And I'm just going to put the rest of them up here. If you want to pause it, copy those down. This is a really good thing to be doing kind of in your notes. So there you go. And that is how we do this. I will say, I just noticed something, that retained earnings should not be there. We haven't done anything with retained earnings yet. So just forget that right now. But hopefully this part of this made sense. The next video, we will be doing the trial balance and we will be doing the financial statements. So, and then after that, the third video, we'll be doing the closings. So, and then the final post-closing trial balance. But this is the first one. Hopefully you've made it this far. And the next one, we will be doing the other pieces. So if you want to take a pause and try to do those on your own, please feel free to do that. But you'll have a good one.